Hello, Sudhaji. How are you?
I'm good, sir. I'm good. How about you?
Fine. अभी हमारे स्पीकर नटराजा जी तो ज्वाइन कर गए हैं.
अच्छा, अच्छा, very good. Hello, sir.
Hello, Sudhaji.
Yes,
Hello.
yes.
Hello, boss.
Hello.
How are you?
Your topic is so good. I really appreciate that you have taken one of the most difficult topic.
It
अब
is.
नटराजा जी तो इंटरनेशनल हो गए तो डिफिकल्टी लेंगे.
बिल्कुल, बिल्कुल.
No, it is indeed very difficult topic. So yeah, I have just taken a brave step to
नहीं, सही.
put an effort.
Yes, yes. हाँ.
Oh, I think only you could have done it.
No.
Will you please
There are
say
a lot
once
of people.
again?
I am one among them.
Nataraja ji has taken 3-4 months to prepare it. He back time for 4 months that I will prepare it the topic.
Wow.
अब तो नटराजा है, तांडव करेंगे इधर.
सही बात है. अब तो शिवरात्रि का माहौल है तो तांडव ही होगा.
पक्का.
So what is this certificate course that you have done now?
This is a IACVS certification.
Okay.
This is international valuation certification. It is from the US.
Wow.
So this will give opportunity to do international valuation.
Wow.
So in top 5, this also is there. Like ACVA is one, and a few others are there.
So it is what, sir? IVS? What? IVS?
IACVS.
ISCVS.
IACVS. International.
ISCVS. Okay.
International Association of Certified Valuation Specialists. I will send you the link, Sudhaji.
No. I just want to say it in my speech today. So I'm just International Association of Certified Valuation Specialists.
Yeah, right.
Wow.
Which countries you can cover in that valuation?
Actually, there is no such thing like Nitinji, like India. In other countries, hardly there are any regulations which will say, okay, only IBBI registered or something like that. In the US and UK and other countries, it should be, the person should be skilled and competent. So mostly people will go to CFA or CPAs. And like these recognition, these certifications also valued. IACVS, CVA, few more are there. So those are recognized.
अभी तो USSR और यूक्रेन के छोड़ के पूरा कवर कर लेंगे नटराजा जी.
बिल्कुल.
And what is the course content in this? Is it similar to IBBI, our core content?
No, it is, see, the fundamentals are same only. It will not be different. However, the global syllabus coverage is given, and most of the US specific research methodology is being adopted. So a lot of research in valuation is done in the US and other countries, European countries. But however, in India, the research, my observation, I may not be the best person, but research is not much in valuation field. Whereas other accounting and audit standards are there from long time. We have borrowed from UK. But valuation field, the research is in the US only.
Just like pharma, anywhere you go, the research is done in other countries. We are only implementers.
चलो, और नितिन जी बेटे का शादी हो गया?
हो गया जी.
चलो बढ़िया. अब नितिन जी ने
बेटे की शादी करके आ रहे हैं.
और क्या सीनियर हो गए नितिन जी?
वाह सर, मिठाई कहाँ है हमारी? So nice, sir. Many hearty congratulations.
Thank you.
I think one of the biggest thing in a parent's life, and I hope that the new member in your family brings lot of happiness and prosperity. to your
Yes.
life
वो भी
and your
यूएस
son's
से लाए
life.
हैं नितिन जी ना, एनआरआई यूएसए से लाए हैं वो भी नितिन जी
अच्छा.
हाँ, वो सब, मेरा बेटा भी एनआरआई है, तो वो भी यूएस में है. शी इज आल्सो इन यूएस.
Very nice, sir.
Is it your son's marriage, Nitin ji?
Yeah.
इट हैज
Oh,
हैपेंड ऑलरेडी.
okay, okay, great.
अब नितिन जी फादर इन लॉ सेकंड ग्रेड के बन गए अब.
Second grade is a bad comment. Yeah.
सीनियर मोस्ट में.
Second, third grade. Huh?
चलो, इस बीच में सुधा जी ने सोसाइटी भी रजिस्टर्ड करा लिया आपके लिए.
हाँ यार, ये तो बहुत बड़ी उपलब्धि है.
अभी आई थिंक बैंक
बिल्कुल
अकाउंट
सर.
का नहीं हुआ ना फॉर्मेलिटी पूरा. चलो पता नहीं. वरना 1 साल से अंडर फॉर्मेशन ही हो रहा था वो. चलिए.
अंडर फॉर्मेशन. क्या 6:30 हो गए, कोई आ नहीं रहा है?
अरे अभी मैं उसको तो देख लूं, जो संगीता परमार को वो करना था ना इंट्रोडक्शन, वो आ जाए. बाकी हमारे स्पीकर साहब तो पहले से ही हैं.
Good evening, Natasha.
Sandeepji, we will start.
Yes, I think it has already been 6:33 now. So we welcome all the attendees in this webinar of our Association of Valuation Professionals. So everybody will be happy to know that our society has now got registered, and we have registered under Societies Act now. And topic today chosen by our speaker Nataraji is also very wonderful. Company specific risk premium and illiquidity discount, which is very
I
rare.
would request everyone to kindly mute their mic.
You have not touched your curriculum since ages, and you are saying.
So our Vice President Sudha Bhushan ji will give the inaugural speech now. Chalo Sudha ji, your turn now.
Thank you, Sandeep ji. It was. I am so excited about today's webinar because the speaker is very renowned faculty and a very learned professional, and my very good friend Mr. Nataraja. And with all the qualifications that you will know later on, there is an icing on the cake that he has recently cleared International Association of Certified Valuation Specialists. He is now the certificate holder in that. So a very good speaker that we have, and that comes on a day where the first webinar after our society, the AVP is now registered as the society. So I would like to congratulate all our members that we are now a society, a registered one. So would like to give a round of applause for everyone who is involved, Sandeep ji, Nitin ji, and under the guidance of Bhave sir, obviously. And the topic today is a very interesting topic: liquidity discount and country risk premium. It's one of the most difficult subject matter as far as valuation is concerned. Everyone knows, everyone understands what liquidity discount is. So when you want to take a equity position in an entity, you generally would like to have an option to liquidate that position if it need to be. Now with publicly traded firms, liquidation is simple and generally has a low cost. The transaction cost for liquid funds are obviously low, but when it comes to the private businesses, liquidation cost as a percent of firm value can be substantial. Consequently, the value of equity in private business may need to be discounted for this potential illiquidity. So we all understand what liquidity discount is, but when it comes to determining liquidity discount, I think it's one of the most difficult tasks. And another subject matter, which is country risk premium. Just to tell you, country risk premium is an additional return or premium demanded by investors to compensate them for the higher risk associated with investing in foreign country compared with investing in domestic market. So, we understand these terms. However, it's very difficult to arrive at the value of these premiums or discounts. So we know that, okay, we can go to Damodaran and take those premiums, use that, but how to actually be 100% sure that whatever we are using is correct or not. So today, that's why we have this very relevant topic, which will be taken by our learned speaker, whom I would now request and Ms. Sangeeta Parmar to kindly introduce. Thank you, everyone.
Yes, Sangeeta, do AVP presentation and introduction of the speaker now. You are on mute. Unmute yourself. भयंकर चार
Sangeeta, you can unmute yourself and introduce the speaker.
You are
You're
on
facing
mute.
some
Huh?
problem. Okay. You want us to take it ahead? Sanjeev ji, I'm looking into it. Just give me 1 minute.
Okay.
So Nidhi will be introducing the speaker. Sangeeta, I hope that's fine, right? Yeah, okay. So the task of registration of society, I mean, it really took us a year and a half, right, Sandeep ji?
Right. But end result is good when it is all good.
Yeah, right. Absolutely right. And we are one of the very few organizations which are so subject centric, right? We only on the valuation and
not being RVO.
Nidhi, can you please introduce our very own Nataraja sir?
Ma'am Sangeeta, ma'am has already joined. So she is going to introduce the speaker. Hello, Sangeeta ma'am.
She is not able to. We are not
Sangeeta has an
able to
audio
listen to her.
issue. She has an audio issue. That's why you are being
I
requested.
had requested you to introduce her. Introduce. Nidhi, can you please go ahead?
Yes, ma'am.
Yeah, please. Thank you.
Am I audible?
Yeah, okay. Now it is okay.
Actually, I have
You have joined from two instruments now, so voice is echoing. Yes, now I think it should be okay.
Hello.
Yes, okay.
Am I audible now?
Yes, okay.
Okay. Sorry, I would not be able to present PPT presentation with this laptop because there's some issue with this laptop, and with another one I'm not able to unmute. So, ma'am, with your permission, can I share the PPT? Yeah, that will be great if you can do that. So yes, I can do that, ma'am. 1 minute.
You are on mute, Sangeeta ji.
Sorry everyone for this delay due to some issue with my laptop and network here.
Is my screen visible now?
Yes, ma'am. Thank you, Nidhi.
You're welcome.
First of all, thank you, Sudha Bhushan ma'am, Vice President AVP, Head Professional Development C. Sandeep Agarwal, Head Resource Committee Nitin Brahma sir, and CP National Coordinator Ashwarya, distinguished member of AVP and dear guest. First of all, as Sudha ma'am has said, please join me to congratulate the team who is working very hard to get this our AVP registered as a society under Societies Act. So now we are AVP is a registered society. Today, I, C. Sangeeta Parmar, is here to give brief insight on what AVP is doing.
फिर से आप म्यूट हो गई मैडम.
Yeah.
I think network don't want me to talk more, and it's so we team AVP is working under presidentialship of Ram Mohan Bhave sir. The sole objective of AVP is to work in national interest in professionalizing valuation as a vocation. Till date, AVP has tie-up with the Indian IIV India Register Valuer Foundation and SME Chamber of India.
संगीता म्यूट हो गया आपका.
Okay. Now you may ask the question, why, who can join the AVP and what are the benefits of joining AVP? So any interested candidate can become life member of AVP just paying 5,000 one-time membership fees. Any professional not need to be registered valuer. Any professional who is interested in valuation can become member of AVP. Within a period of 8-month pre-registration time, AVP have achieved so many things. One of them are AVP has tie-up for CPRs with IIV, RVF, RVO Pune. Till date, 156 professionals has become life member of AVP, they are from foreign countries, and these are some of them are iconic personalities like past president from ICMAI and internationally certified valuer, prominent speakers. Within this 8 month, AVP has published 9 e-newsletters and 1 independent day special newsletters. Till date, 45 webinars covering different hot topics has been covered, done by the legends. Now I would like to give some intro about SMEs. SME Chamber of India. Sorry. Yeah. SME Chamber of India is continuously working for the development of SMEs from manufacturing, service sector and allied industry business sector for last 28 years. SME Chamber of India is providing unique support to SMEs, young and women entrepreneurs and startups to convert business idea. SME Chamber of India is converting new concepts into profitable business ventures for better development as well as transition and transformation. SME Chamber is channelizing finance from banks and financial institutions, export finance, venture capital, etc. for enhancement of business and activities. Now let me put some light on IIV RVF. IIV RVF India Register Valuer Foundation is recognized by IBBI as Register Valuer Organization as per the provisions of Companies RV Rules 2017. AR Ilyas Amin Sheikh is a managing director of IIV RVF. IIV RVF is to promote and develop the professions of valuer. IIV RVF has been contributing immensely to the enhancement of valuer through its academic programs and imparting teaching. IIV RVF conduct 50 hours training program for registration as registered value with IBBI for all class of assets, not only one class. So if you are a member of any of class of asset, say SFA, building and the other machinery class, even then you will not get any problem complying with your CEP credits. Till date, IIV RVF has trained more than 1,400 members for IBBI 50 hours training, and more than 246 members are successfully registered with IBBI. Now you may ask, Sangeeta, what are the benefits of joining AVP as a life member? So when you join AVP as a life member, you will get free webinars, at least 2 each month. You will also found mentorship from the our senior member who are providing mentoring to the newly registered valuer and the students. You also got monthly e-newsletter for sharing knowledge. You got platform for networking at national and international level. You will got studies of IVS and valuation standard issued by various bodies. You can participate in activities of various committees formed. You can got chance to attend international webinar at discounted prices. Formation of various study group to enrich our knowledge in particular area of work. Till date, 26 days knowledge sharing event already fixed for upcoming webinars. You will get CPR credit under continuation education program in association with IIV India Register Valuer Foundation RVO. So this is our journey so far. We have covered all the topics, all the hot topics in the for the as a subject, and with the eminent speaker have covered all this topic, and we have already fixed webinar detail up to August 2022. So you can contact for any query to our President Ram Mohan Bhave sir. For any membership assistant, you can contact Nitin Brahma sir, and for any webinar related query, you can contact C. Sandeep Agrawal sir. Thank you. That's all for the AVP presentation. Now I would like to welcome our own speaker, Natraj Nanjudaria sir. He is also member of AVP. First of all, I would like to congratulate Natraj sir for completing international valuation certification with IACVS. Congratulations, sir. Now I would like to give brief intro of Nataraja sir. Nataraja sir is a practicing cost accountant, registered valuer SFA, insolvency professional, partner BBS, and associate cost accountant. Natarajan sir is strategic professional with multifunctional experience of 24 plus years with success in all aspects of finance, human resource operation, process transition, operation excellence, and global stakeholder management. Worked with ADP, Amazon, Infosys, BPO, and Deutsche Bank. Natraj sir held positions such as head of finance and accounting function, head of payroll operation, process transformation expert. Natraj sir has worked on global projects with global stakeholder, has achieved result-driven performance in the area of operation excellence, process transition, customer excellence, product integration, and process transformation. Now, please welcome our speaker of the day, Natraj sir. Over to you, Natraj sir.
Thank you so much, Sangeeta, for your kind introduction. Thank you, Sudhaji, for your introduction and the kind words, and thanking me, congratulating me for my international valuation qualification. Okay, so as you say, as Sudhaji was mentioning, today's topic is obviously really a difficult one. I thought it's good to take up this kind of subject so that we will be able to really understand, and also I will get an opportunity also to share my knowledge as well as do sufficient research in this field. So let me try to present my screen. 1 second. Okay, here you go. Okay. So the topic which I will be covering today is going to be on premiums and discounts. So here I will be specifically covering company specific premium, illiquidity discount, and terminal value. I will try and cover as much as possible. However, some of the aspects are very much research oriented and very much detailed. So I'll present my findings and also the compilations which I have. So we could go dive deep as and when it is required. So first of all, before we go into company specific risk, that is the first topic which I am going to take. So let us high level understand what is risk. So Ashwath Damodaran explains risk means danger and opportunity. So how do we understand risk? Let us take a simple example. If we want to make an investment, we would either go into a government security or equity or debt instruments, or if we want to be an angel investor and stuff like that. So why is it whenever you are making an investment in equity, the returns you are expecting is high, whereas when you are actually investing in a government security, the returns you are expecting is not so much? The reason is that the liquidity, here I am talking about liquidity risk. So if you are investing in equity, then you are not as much sure as when comparison with the government security. If you are investing, then you will not be as much sure as similarly whether you will get back the money or not. So you would expect to recover your principal as well as interest in a short duration. So liquidity plays a very important role here. And when it comes to other aspects, so what kind of business you are investing in? If you are investing in a retail business, are you investing in a long-term business? If it is a manufacturing industry, if it is something to do with infrastructure development. So there actually the business risk is calibrated, actually, I would say. So if you are investing in a, let's say, e-commerce company, so the business risk would be high. At the same time, your returns will also be very high. So the kind of risk which we are dealing here depends on industry, depends on the kind of business we are talking about, kind of economy, where you are investing. Are you investing in India? Are you investing in US or UK or various other countries? So depending on that, you also have exchange rate risk and country specific risk. So high level overview of cost of capital and equity. So in general, whatever you are expecting, the expected yield is basically measured in terms of risk-free rate and risk premium. So risk-free rate is usually a real rate of return plus inflation. So here in India, we will be considering government securities, whatever investment you are going to make, and what is the risk-free rate will be your risk-free rate. And as far as risk premium is concerned, you are going to either use BSE 500 for 10 years or 20 years to arrive at the risk premium. So what are the various methods we have in terms of calculating cost of equity? So the usual method what we use is CAPM, capital asset pricing model. In capital asset pricing model, you have risk-free rate plus beta plays a major role. Based on the industry you are looking at, the beta is arrived. And what is the expected return on market portfolio minus the risk-free rate. So CAPM is one measure. And once you arrive at the cost of equity, depending on the debt portion, you arrive at the weighted average cost of capital. Apart from CAPM, we have Duff and Phelps Ibbotson method and Duff and Phelps modified CAPM. What is different here? Here in Duff and Phelps build-up method, you are actually calculating risk-free rate plus equity risk premium and industry risk premium and size-specific risk premium and company-specific risk premium. So all these things are separately arrived. Similarly, in modified CAPM, you are arriving at risk-free rate plus equity risk premium multiplied by beta, similar to CAPM. And you are also adding size-specific risk premium here and company-specific risk premium. RRCM. So this is another model wherein you take various aspects and you kind of do the scoring for competition, management ability. Just a moment, I need to just, okay, this is good now. Okay, the risk rate component model covers competition, management ability and depth, financial strength, profitability and stability of earnings. So there is a detailed modeling which is adopted here. It is a scoring methodology. So the next one, what we use generally is market method. So market method is usually something like revenue multiples or EBITDA multiple or transaction multiple. So some cases where you are you're not having much of revenues, but usually in case of startups, and if it is a something like e-commerce company, the current scenario, there are various situations where you will have to use transaction multiple. If you have e-commerce company wherein most of the things are dependent on app, so then if you have developed an app, then probably you might not have too much of revenues. However, it's something like that. It's technology based, and it's really promising technology. Then you actually compare with, let's say you have a app which is related to healthcare industry. So what you can do is then you can compare with any other apps like Mfine or Form Easy and stuff like that, and you will have to extract the data in terms of how many transactions or how many app downloads are there, and stuff like that, and then compare the revenue per the transaction. So accordingly, you can arrive at valuation using transaction multiple method. So what is that CAPM is covering actually? CAPM is covering risk-free rate plus equity risk premium, and main disadvantage here is no private information, measures equity risk premium based on systematic risk, and beta of asset relative to market portfolio, which is based on the regression modeling. So here it only considers the systematic risk, and unsystematic risk is not something which is considered in CAPM. That is the reason we will have to use other models like your build-up model and modified CAPM, wherein you can bring in other risk premiums like company-specific risk premium, industry-specific risk premium. So systematic risk, we are talking about risk. Systematic risk is the uncertainty of future returns resulting from the sensitivity of return on the subject investment to movements in the return on the investment market as a whole. Unsystematic risk is a function of characteristics of industry, individual company, and the type of investment interest. So how do we calculate company-specific risk premium? So basically, we are trying to deal with unsystematic risk. There is no database or empirical study when we talk about company-specific risk, and there are hardly any measurement models. It is all qualitative models, and there is no specific formula which we have in terms of calculating company-specific risk. So it's more to do with professional judgment of the valuer. So when I actually started doing valuation, when I checked with my peers on how do you really take company specific risk, so I most of the times what I heard is that okay, it is most of the times what I heard is it's based on the judgment of the valuer. So there were not really many models which I came across. So I mean, I kind of did the research and have come up with few models which I'm going to present here. So what are the factors we are looking at when we are trying to arrive at company specific risk? So it is competition, which you need to look at, financial strength of the company, management ability and depth, profitability and stability of earnings, national economic effects, local economic effects, and competitive analysis factors such as micro environmental factors, industry factors, company factors, functional analysis factors, risks associated with economy, operating risk, asset risk, market risk, regulatory risk, business risk, financial risk, product risk, technology risk, legal risk. So we also need to look at various conditions in which we are looking at the company is operating, the economic conditions, location of business, depth of management, barriers to entry into market, industrial conditions, competition, quality of management, the bottom line. So in the nutshell, some of my observations when I have done some of the startup valuations is like, let's say their product is good. It is a very good innovative idea. However, they lack in some of the aspects, like is their corporate governance appropriately defined? Is their marketing strategy, is it defined clearly? Do they have a clear strategy on how do they acquire the customers? What is the customer acquisition cost? What is the customer acquisition strategy? What is market penetration strategy? So these things are not actually available. So even if we talk about internal controls, what kind of internal controls they have in terms of competitor analysis, how they are going to do, they are going to deal with the competitors in terms of competitive, what kind of competitive advantage they have. So these aspects they are not able to address. So that is where I think company specific risks come into picture. And some more aspects like, okay, there are few founders, there are founders, promoters, and there are few technology people, and there are staff. However, do they have succession planning in terms of how do they ensure that if there are some key management personnels, if they are leaving, how will they manage their operations or their technology systems? Do they have DRBCP, business continuity planning? So all these things clearly defines how you are able to arrive at company specific risk. So this is where I kind of try to use my experience in terms of what I have actually learned in corporate and the organizations I work with, like Amazon and Infosys and Deutsche Bank. I mean, I clearly understand the leadership principles and the methodology they adopted in terms of how they actually navigated into the market. If I just take an example of Amazon, India, they are actually still loss making, and they always believed in increasing the revenues, and they are not bothered about really whether they are making losses or profit. So the only agenda was to acquire the market share. So if you see, if you use dividend discount model or something like that, you will not be able to arrive at the valuation what the kind of equity the market price Amazon is at. So every year it is doubling in terms of the share price. So the strategy is completely different. It is how diversified you are in terms of your market portfolio, how strong is your leadership pipeline, how strong is your strategy. So employee retention culture and all these things really matter. So this is where we can use our skill set to arrive at company risk specific premium, and we can ask those probing questions to the management. So I did talk about the market penetration factors in terms of how you are able to have a competitive advantage. So anybody, if you are doing evaluation, they should be able to define how they are different. What is the strategy they are adopting in terms of Mikhail Porter's competitive advantage strategy? Is it like, are they focusing on cost? Are they focusing on technology? Are they focusing on quality differentiator? So what is that they are trying to do? Are they trying to focus customer experience? So this kind of thing has to be very clear. So I think I talked about this also in various ways. So what kind of internal controls they have, what kind of fixed assets age and conditions, strength of intangible assets. So the model I'm trying to use here is something which prescribed by ACVA, which is a association of certified valuer specialists, International Valuation Association. So here we are talking about the measurement factors, operations history, volatility of revenue and earnings. So if it is a startup, you will have all three factors negative. So similarly, you will have to see if it is in the life cycle where it stands, whether it is at growth stage or maturity stage. Accordingly, you will be able to assess what kind of rating you will have to give. So in terms of service line diversification, is the company focusing on one product, or do they have various products? So in terms of diversification, so that is something you will be able to assess and give the scoring. So if we take an example of Dunzo is not only into delivery, now they have also entered into food and grocery delivery. So I think reasonably they do have diversification. So that is one example which we can take. So in terms of technology, so do they have continuous technology advancements, technology solutions, or is there technology which is become obsolete? So this is something which can be looked into. Key employee dependency is important. And do they have long-term contracts? I mean, if we take an example of pharma company with steady growth, and if they have already long-term products and long-term contracts, then I think that is a plus point. And we'll have to look at the ownership, license, and proprietary patents. Do they have the brands registered, trademarks, copyrights? This is something which will really have an edge over, and it's a plus point. So I'm trying to give you an example here of scoring. Let me just go into the Excel sheet. So this is an ITES company which is into MSME services and accounting services and various other IT-enabled services. So this is around 1.5 years old company, but they have picked up good traction, and I have done the valuation of this company. So for the purpose of confidentiality, I'll not be able to state the company name. So when I did the valuation for this company, so I looked at the first point. If we take operations history and volatility of revenue and earnings, so all the factors is actually since it is a new startup, you will have to give the scoring of 3 here, all 3 factors plus. So let me just explain you how this works out. So for 1 to 4, you are actually giving a positive scoring, and the next step is here on long-term contracts and ownership, etc. You will be giving a negative scoring. So here, basically, if you are giving a negative scoring here, so this will reduce your risk. So here, more and more score you give, your risk is high. That is what you are trying to say in 1 to 4. And 1 and 2, you are going to give a scoring which is negative. If the factors are good, if they have long-term risk factor, that will actually reduce the risk. Sorry, long-term contracts, that will reduce the risk. And similarly, if they have done their branding, that will reduce the risk. So on the next point, lack of service line diversification. Here I am saying there are diversified services. However, all the services have not started. So I am giving one point here. So on obsolete information technology systems, I think this is a new software, so software development in progress. So I'm not giving any negative marks here. And similarly, key employee dependency, the most of the dependency is on promoters, founders. I didn't see much of succession planning. So I am giving 2 points here. So that will become 6, and this will remain in that way because they don't have any long-term contracts, or they don't have any branding yet done. So with this, I am able to arrive at company specific risk of 6%. So you will see company specific risk is 6%. So one more thing which I want to mention is that when you are actually considering the company specific risk. So overall, I think what is important is you need to look at what is the discount rate you are looking at, and what is the valuation you are looking at. So similarly, I think all these things are interlinked. So depending on, see, your beta is linked with your company. See, what are the driving factors? Your risk-free rate and market risk premium, and your beta and company-specific risk and illiquidity discount, and also the terminal growth rate. All these things are the driving factors. And obviously, in terms of your cash flow projections also. So how is your revenue pattern? How is your working capital changes? How is your investment into capex? What is the kind of cash and cash equivalents you are holding? What kind of investment you are bringing from long-term borrowings? So all these things does influence your valuation, and depending on that, and whether it is a technology product or whether it is a regular business, because if you have an innovative technology, then the comparison companies will be something really different. So you cannot really value a technology business or a innovative startup like you are valuing with the traditional methods. So then you will not be able to achieve the kind of valuation we are looking at. So if that kind of valuation you are doing, similarly, you will have to look at all the factors. So if you see here, what I have done is I have used revenue multiple method also along with the DCF method. So by using revenue multiple method, I am able to arrive at what is the valuation I am getting. So here with my research.
May I interrupt you, sir?
Yeah,
please. Sir, what you are talking is not visible on screen, I think. On screen, this illustrative example of qualitative study is coming, sir. PPT.
Oh, is it? Okay, I have shared Excel.
No, it is not there, sir.
Oh, okay. Okay, thanks for letting me know. Let me just show. Go back. Okay, only this is coming. Okay, stop. Let me just share again. Okay. Okay, so I was talking about just I will repeat a few points here. I was talking about the factors which will influence your overall valuation. That is your risk-free rate, market risk premium, beta, and also company-specific risk, and your terminal growth rate, and your the way you are doing the taking the terminal value. Apart from that, your cash flow projections in terms of how the revenue is actually shaping up, in terms of how the working capital changes are there, and long-term borrowings and capex and all those things, and cash equivalents. So now, how I arrive at company-specific risk premium is a combination of your valuation in terms of okay, if we use revenue multiple, 10 times revenue multiple, if we take, we are getting a valuation of 3,000 lakhs here. However, our current valuation is 3,184 as per DCF method. So what I usually do is, based on this, your company specific risk also can be adjusted. So that is one thing which we can keep in mind. When I say adjusted, it is not actually to really arrive at some valuation, but you will get a holistic picture in terms of how you can compare with DCF valuation, your company specific risk, and if your terminal growth rate and everything, you'll be able to get a holistic picture. So this is one method of doing using calculating company specific risk. There is another method which is called factor analysis. Factor analysis is based on the revenue growth, operational risk, profitability, industry risk, economic risk, and customer concentration. So let me just show you how the factor analysis is done. So this is the scoring system we have in terms of factor analysis. So any tool you take up, I think you will have to be sensitive about whether you can use that tool for your valuation or not, because it may not be really completely 100% you can use that tool. What I have done here is I have used 50% of factor analysis and 50% of my qualitative analysis to arrive at the CSRP. So this is again an example which I am sharing. So here we are talking about how do we really arrive at factors. So we are talking about revenue growth. Revenue growth, you are able to see the screen, no sir?
Yes, sir. Yes, sir. Visible, sir.
Okay, great. So revenue growth is the deviation of historic and expected revenue. So based on this scoring, if the deviation is 0 to 10, what is the rating you will give? And similarly, 10 to 20, and it goes on like that.
Sir, the higher the rating, the better the company, kya?
No, the rating is high means your see, let's take the example. If your revenue growth deviation from expected, it has to be less, right? If it is very high, the deviation, that means there is a risk involved. So the points always, the scoring in company specific risk, higher the rating, it is not good. The risk is high. So then let's say your company specific risk is 7%, 10%. Then what will happen? Your valuation will come down. So your company specific risk is less, your valuation will go high. But that doesn't mean that we bring it to 2 to 3%. Usually the standard is maintained between 5 to 10%. 10% is also considered very high. If you make it, if the moment you make 10%, you can see in your template the valuation drops drastically. So operations risk. Operational risk is what is the percentage of fixed costs to sales. So here it doesn't mean that, as I said, see, these are all models developed and it's hypothetical. So we need to use this carefully. So does this mean that we should not have fixed cost? Without having fixed cost, we cannot operate. So this reasonable fixed cost is good. So that we need to be sensitive about that while using the model. So profitability, deviation of historic and expected profit. This is also similar. So industry risk, firm ROA, return on assets compared to industry ROA. Economic risk. So when compared to GDP growth, how is return on assets? See, usually return on assets is always more than GDP growth. So I would not really consider this factor really so much. So we can still look at evaluating the same. Customer concentration. So how is it? Are you concentrating most of your revenue on few customers, or is it diversified? So that is one thing, but depends actually. If you are in a construction industry, then your customers are only few, so you can't really assume this model actually. So we'll have to look at the industry then. So what I have done.
Only one question, sir. These percentages are fixed, or it will change from company to company, sir?
No, actually, see, this is from one of the ICAI material actually. So this is something from the research finding. So what you can do is you will have to see. I mean, initially only I told that company specific risk. There is nothing like, okay, CAPM or something like that is not there. There is no beta for company specific risk. So you will have to use your judgment. So these models will help you to justify how you arrived at it. Otherwise, I have seen people who will take 5% or 4%. Okay, generally it has to be 6%. That time only I was not very convinced. I wanted to find out what are the models available. So in fact, if you look at some of the BVA resources, international BVA resources, there is some database called Morningstar. Morningstar will give you company specific risk. So all these resources are available in the US only. In India, Capital IQ is there for you to get the industry specific comparisons. But however, whether it will give you some model wherein you key in some numbers and you get company specific risk, I doubt. I have not come across. We have to see that. So here, based on the company which I am evaluating, I have actually arrived at I have taken the performance. So here is the performance and what is the revenue growth and various parameters I have applied that, and I have got the company specific risk of 3.2. After that, what I have done is I have also taken qualitative factors. So here I didn't take operations history, volatility, and revenue earnings because that is already considered. So other aspects like lack of service line, obsolete, key employee, all these things I have taken and I have arrived at 4. So based on that, I have got 7.2 for this. This is another company, not the same company which I was doing valuation. This is into this is a technology based company which has a very good innovative product. So this is another startup. The other one was another startup which I have done the valuation. So this is about the company specific risk. You can use different models. Factor analysis is one model. The previous one is actually recommended by ACVA, International Valuation Association. And this one is recommended by ICAI, one of the material. So it's not like we have a stamp or something. It's something we have gathered and we need to try and use these models.
Nataraja, where do you add these figures? This 7.2 and 4?
Okay. So what you do is, wait, I need to share that screen. So you go to, you can add this to discount rate. Discount rate. See, your discount rate will comprise of risk-free rate, market risk premium, and your company specific risk.
So you jack up your cost of equity with that.
Cost of equity. It has to be company specific risk is part of cost of equity.
Yeah, got it. Thank you.
Okay. So the next item which I want to cover is terminal growth. Terminal growth factor, usually what is the basis on which we have to take terminal growth is always a confusion. So one of the thing which we can look at is it should be less than the GDP growth rate. So usually I take GDP growth rate, not the historic. We can take the GDP growth rate for next 5 years, because next 10 years projections I am not able to find. Next 5 years projection is there, which comes to in the range of 6 to 7%. So you cannot take, okay, because we are talking about terminal growth rate, we cannot take, okay, entire 6%, because we are talking about perpetuity. Already you have grown the company, you have done the cash flow projections for next 6 to 7 years with huge revenue growth in terms of 25% or 30% or 40%, sometime even 60%. So your terminal growth will be less than 5% usually. However, there is an argument that, okay, terminal growth, if I take 4% or something, I will get a number, but however, that is not satisfactory, because I will say that my company will stay for a longer time. It's not just 5 years I'm going to have this kind of high growth. Another 5 years or 10 years, I will grow in the same fashion. So you have an option, either you want to project the valuation for next 15 years, or you can use a hedge model. Hedge model, if you use, you will get this kind of, let me just show it with an example. Hedge model, if see, I have, for this calculation, I have done terminal growth using 4% normal calculation garden growth model. I have got 1468. However, if I use hedge model, it is 2,244 2244 lakhs. So here, how I actually compare. This is one crude methodology, not really. What is the present value? If I take the total of present value is 9.943. If I take terminal value divided by present value, it is PVs of your cash flows I'm talking about. It will be 1.45. However, if you take hedge model, you will get 2.37. So this is one checkpoint. You can see how much increase you are giving. So it is like what? Your present value, your terminal value is double of your net present value of the cash flow. So that is something you are looking. So I have taken here length of short-term growth as 10 years and 15% short-term growth. This is again, actually in real valuation, I have taken much less because this is quite high. 5 years plus 10 years growing at this pace is it's much higher. So I have taken around in real valuation around 5 years. So if I make it 5, a lot of things changes here. So you see, if you are, it will come to 1.696 times. You can see it is almost near 1468 and 1856, not much difference. So you will be able to see that difference. So that is That is one way you can look at. And again, always it is better to have one more valuation based on another model, so that you are able to compare where your valuation is going. So that is one thing. So this is how you can use H model. So this is very much indicative analysis of terminal growth and company specific risk premium. So here we are talking about terminal growth characteristics, which is like usually it has to be less than GDP growth rate, and it has to be it can be compared with inflation rate. So if there is a high past growth and company is in the growth or maturity stage, then will you take less terminal growth rate? High industry growth, then are you able to take a high terminal growth rate? Similarly, company specific risk premium. If it is new company, you will have a company specific risk premium which is higher. High past growth and company is in the maturity stage, then again I think it depends. Actually, it can be, it need not be very high company space CSRP. It can be moderate or less. So high industry growth rate, you can consider a moderate or less CSRP. Okay, so so next topic is illiquidity discount. Here again, my observation is that illiquidity discount is there are some cases where I observed, okay, well, let's take some number in terms of, okay, is it 4%, 5%, 7%, 8%? It should be 10, less than 10%. So these are the general general things which we hear when we talk to our peers and valuers. So what are the various factors which influence illiquidity discount? So this is one topic which is very much deep. The DLOM calculations, we have various models in the US. However, in India, not all these models are applicable. We'll have to consider whether or not we can use those models, and we may have to do a comparative analysis within the industry or the business which we are trying to look at, or we can look at what are the past performance or past IPOs, pre-IPOs which was done, and what was the valuation which was done. So that is something which we may have to look at when we are doing the illiquidity discount. Because in terms of the research database for India, not much we do have. We'll have to do our own research actually. So illiquidity discount is based on liquidity of assets owned by the firm, financial health and cash flows of the firm, possibility of going public in the future, size of the firm. So these are various factors. So what is the background behind this illiquidity discount? So this mainly has been originated from the detailed study of restricted stock in the US. So usually the stock issued by publicly traded companies in the market, and they have not been registered under SEC, Security Exchange Commission here we are talking about. But the stock cannot be traded for 1 year or something like that, because restricted stock means you have a lock-in period and you will not be able to sell during that time. So what you do at that point of time is you actually go to the private investors and then try to sell these stocks. So that's when the discount factor comes in, and over a period of 30-40 years, the data has been collated, and then the discount factors has been arrived. the average discount factors, which is around 25 to 30% in the US. So next scenario is pre-IPO transactions. Whenever there is an IPO happening, just before the IPO, 6 months before or 1 year before, if there is a private investors or private placement which is being done, then also there is a discount which is being calculated. So in both cases, discount is estimated difference between market price and the liquid asset and the observed transaction price of illiquid asset. So what is discount restricted stock? Stock price minus price on restricted stock offering. Discount IPO offer price minus price on pre-IPO transaction is your discount offer price. So,
sir,
yeah.
To understand in layman language, sir, it means like where the company is going for an IPO or there is a private placement in the past, like 6 months down the line. So in those cases, the illiquidity discount will be lesser compared to an ordinary company where we can't anticipate IPO or private placement. Is my understanding clear?
Yeah, you are right. Actually, there are two scenarios. One is public companies, whether it is traded or not is secondary. The other is private company. So Ashwath Damodaran offers two models. One is a restricted stock model for public companies. And there is another model which is called bid-ask spread for a private company. So you can use bid-ask spread, which I am going to show in a while, for private companies. So private company valuation, you can use bid-ask spread, and again, see, you'll have to use the judgment in terms of what valuation you are getting and stuff like that. You can't really see when you use bid-ask spread, the discount is not going more than 15%, which is good. Your liquidity discount when you do valuation, it can be somewhere around 6 to 7% to 12%. If it is going more than 12%, then the valuation will come down drastically. So that is that model helps you to arrive at that discount rate. However, if you use a public company discount model, your discount will go up to 20-25%, which cannot be used for private companies. So that is where I think your pre-IPO modeling, you can use that model. I'll just show you that model in a short while. So we talked about this screen. So go to next one. So the evidence of liquidity discounts comes from examining restricted stock at publicly traded firms. So here, basically, we are talking about a lot of study which has been done. So I can just show you something. So here, I mean, these are the guys who did the study at various junctures, and then there is a model which is developed by these people, which is basically we are talking about log normal of RPRS, which is relative price of restricted stock, and you consider revenue here of the private firm, and restricted block relative to total common stock, and your whether the earning is positive or not, and your customer relationship, is there a customer relationship or not. So I will just show you this one. Let me show. This is for a
Sir, when you say customer relationship with the investor, you mean that the investor was a customer of the company? or
not that actually. Here, customer. Yeah. Whether investor has a customer relationship or not, that is important. That's what is measured. You are right, actually.
okay. The customer has become investor, you mean to say that?
No. If there is a relationship, then the discount rate will change accordingly. Because if there is a related party, no, so accordingly the discount will also change accordingly. So here, I think, let me.
How do you know whether an investor is a customer or customer is an investor?
Yeah, Nitin, I think that's part of the analysis. I think that will come, that will be disclosed, right? So that is part of the disclosure.
Sir, can we ask these questions to the client, while doing valuation?
Yes, that is part of your questions. No, you should be able to ask.
Sir, but I am not clear about the question itself. So,
Just a moment, I am trying to get that sheet. Okay, so here, if we take example of restricted stock regression, so this is where I have used the example. So yeah, was that Nidhi actually?
yes, sir. Yes, sir.
Yeah. So, okay, so here, okay, practical example, I'll be honest, I also don't have, because this is specifically US based companies. But if we look at logically, I think your question, you could be able to ask the question, because if your customer, whether related to investor or not, I think that question is not a problem. You will be able to ask that actually.
Okay, sir.
We'll have to look at that kind of scenario, whether in India, do we have such kind of scenario or not. So here I have taken the revenue example. So here the first year revenue, what I have is 150 lakhs. If you convert that into US dollars, you will get 0.2 million revenue. If you put 0.2 million revenue here, so this is the thing which we can use for calculating illiquidity discount. As I said, if you use restricted stock regression, you will get around 30% or 35% discount. So this is for public companies. Public companies, I think the discounts are higher. So revenue you will be able to plug in, and then base discount. So base discount is something which is already here in terms of when you look at revenues, revenue is below 5 million, which is where I am taking 26% discount, profitable firm. Okay, and how much you are actually trying to dilute, how much you are selling, is it 10%, 15%? Based on that, let's say I'll put 50% here, there will be a change here. And if you put 100% similarly, so there is a small change. And whether you have negative earnings, if I put 0, the discount will go up. Similarly, if you make the changes accordingly, it will go up. So the next one is your private company. Private company, you can use a different model which is called bid-ask spread. To make estimate of illiquidity discount using bid-ask spread as a measure, you would need to relate bid-ask spread of publicly traded stocks to variable that can be measured for a private business. For instance, you could regress the bid-ask spread against the revenues of the firm and a dummy variable. So this is again a similar formula which is using regression and log normal, wherein you have you can arrive at the illiquidity discount. The same. So in the same example where I have done the cash flow projections, if I take that and then if I take the first year revenues, which is 0.2 million US dollars, and whether the earnings is negative or positive is another one. So they are into profitable situation, so it is positive. And what is the value of cash and cash equivalents versus value per share, and whether it is traded or not. This company being a private company, it is not traded, so you will put 0 here and you will arrive at a valuation of a discount of 13.33%. Similarly, you make changes here, whether if you make 0, then the discount percentage will go up.
So your Excel is not visible again. Only PPT is visible. In case you're showing any Excel.
Yeah, I am showing, yeah. Now it's visible, right? Yeah.
Yes.
So here I talked about revenues. So revenue, yeah.
Positive or negative earnings will always be in the range of 0 to 1, right?
Yeah, it's only 0 and 1. That's all. Okay. If it is the moment you put 0 here, the illiquidity discount will go up. Similarly, you change trading volume, like let's say 25%, it will come down, because if it is actually traded, then you will the discount here, it's not illiquid. That means its liquidity is high. Similarly, you'll be able to get this valuation.
Sir, this Excel file or models are available on a website of Aswas Damodaran?
Yeah, it is available.
Okay.
I will share these files.
Thank you, sir. Thank you.
So this is one. So apart from this, there is, as I said, there is a study done on DLOM on put option, using put option pricing model. So here the kind of usually there are let me talk about this one actually. So there are different models done by these guys, Chaffee, Stoutport, Longstaff, and Finnerly and Kairade. So these are, I think each model, I think will take a lot of time to really go through. So that's why I've captured high level characteristics in terms of how these models works and what are the characteristics, what is strengths and what is weaknesses. So here Chaffee model goes with European fixed strike rate, and Stout goes with the European fixed strike plus a Stout premium. So as you know, European fixed European put option you will have to, you can exercise your option only at the period, end of the period. And American option, put or call option, you can exercise in the middle as well. So that is the major difference. And to calculate DLOM, these models are used, and these guys have come up with various models. So the first one, Chaffee, is using Black-Scholes model, and others have different various models. So, for example, Longstaff uses the model wherein you will be able to take the highest rate in terms of, let's say you have sold the option at a particular price, but because it's an American option, even after the end of the period, you will be able to go back and select the highest rate it was traded, and similarly you can encash that based on that strike price and market price. So that is why it is called look back. So assumes perfect market. So considers risk of price increases during the holding period. So that is the advantage of Longstaff. So Finnerly is one, and Gairodev. So all these models actually, I think, more from the US perspective, but we could try and use this along with the market comparison and market study we'll have to do. Let's say we are doing a valuation of new e-commerce company, then we can probably take let's say we are doing a fintech company, then we can look at Paytm valuation and any other valuation, and we'll have to do a comparative analysis to and also consider these discounts to arrive at the appropriate discount. So if we look at comparison of various models, how they fare actually. So DLOM and volatility. So basically this models are dependent on volatility and holding period. Holding period we are talking about 6 months here, based on assumed 6 months holding period. Each model is performing in different ways. If we use transformed Longstaff is on the higher side. If you see the discount rates, lower the volatility, the discount is also lower, and higher the volatility, the discount is higher. So it's pretty straightforward there. So let me just share one more analysis. So this is the example of, I was talking about the restricted stock study done in the US. So just not going into details, I'm just sharing in terms of what is the timing period covered and what was the reported median and mean. So these are various studies which has been done. So I have actually, I have all the resources here in terms of whether risk-free rate or beta or cost of equity, beta calculator spreadsheet, and dividend yield, terminal growth rate, GDP growth rate, company specific risk premium, Indian companies, what is the database which we can use, US companies, what is the database, BVR resources. So these are some things which are my findings and which are my compilations. I am sharing that in this presentation, and also the study which I mentioned in terms of the DLOM study, this complete studies, and also the CSRP calculation resources, I will share it with you guys. So probably we might need a different session only on DLOM with Black-Scholes model and put option pricing model, so that we can go deep. I think just to understand probably two models, we may have to take one full session. So probably that we can do some other time. So I thought only high level DLOM I will share. Otherwise, we do have Ashwath Damodaran's template, which we can straight away use for bid-ask spread for any private company valuation. I am done with my presentation. Anybody has any questions?
Sir, actually, it was very insightful, sir. Thank you very much for sharing this valuable input, sir. My question is, sir, for a new valuer, what is the platform available? As you will appreciate, this valuation is a highly judgmental and subjective matter. So for a new valuer, which is the best platform available to learn, like a pilot learn on simulator? So for valuer, which are the avenues available, sir? New valuer.
Sir, actually, Ashwath Damodaran site is very, very good, sir. No doubt, I can tell you, and it is very in the resources I have shared that Ashwath Damodaran's site details also, but others are available, sir. It is paid. So Capital IQ, Morningstar, sir, BVR resources is like, it is in dollars, sir. We have to pay. Now, hopefully, because I have done international valuation course, I need to check whether I will get this resource free. I am not sure. Someone was telling I will get. So I'll have to check. Similarly, this Capital IQ, if you go for full resource, it's expensive. But sir, in our group, Bhave sir has negotiated, and some 25,000 per annum or something, some resources he's telling it's available. That Value Tico, we'll have to check, sir. You can try that one. Apart from that, you can use Probe 42 for your comparison companies, sir. That is 3,000 rupees per annum. You will get 10 users, 10 companies you can download. Otherwise, there are some more, sir. I can't remember immediately. 140 rupees you pay, you will get the complete download within 1 or 2 hours of the company which you are looking for. But MCA site, 100 rupees you will get. 140 rupees also, what you will get is the same MCA database, sir. But only thing is, you don't have to log into MCA directly. That is called QFD or something, I will tell you. That you will get. Same company, they will give it for 300 rupees full analysis, sir. So better than that is Probe 42, sir. You can get full analysis in Excel sheet. MCA website, if you download everything, you will only have to do the analysis. It will not be in Excel. So that is one problem. I'm only talking about not the valuation resources, that the comparison companies I'm talking about. But valuation resources, Ashwath Damodaran site is good. Apart from that, I think Google is important, sir. We have to do Google and keep on checking.
Thank you, Natarajan sir. So one more question someone has asked is which book to refer for doing valuation, like where we can find all these methodologies.
Again, I have not read any other book because I happened to do this international valuation course. Those materials, what they shared was very good. I have referred that. Apart from that, Ashwath Damodaran has published many books. There are a few others also. I have not referred, so I will not be able to say anything. So I think that's what I can say. Ashwath Damodaran, and there's one book which somebody referred to me. I can't recall now. This BVR resources. When I share, no, you will get a lot of books over there also. I have seen some books on DLOM and. I can't remember the names because I did refer to those for some time, but I can't remember the names. I will share that in the group.
Damodaran also there are plenty of books. So which one or two book you will suggest, sir? Which will be the best, sir, for a beginner actually?
Sir, Damodaran, I have always looked at. Sir, I will tell you one thing now. I remember, sir. If you go to Ashwath Damodaran website, sir, YouTube channel. YouTube channel is there where all the videos he has uploaded, all his corporate finance classes, everything he has uploaded. So I would suggest you Stern NYU website is good, sir. That is enough for you. And Ashwath Damodaran YouTube channel is good. All the teachings what he does, he has actually uploaded those in the videos. So a specific book, I really don't know, sir, because nowadays taking book and reading, because these exams were there, I read book. Otherwise, all on
YouTube, website. Sir. Yes, yes.
Yeah, somebody, you have shown the material from Willamette, whether this material is freely available. Whatever I have, I can share, Anil. I don't have the book. That material is something I have researched and found out. Any other questions? Okay, then I think I'm done.
Yes, sir. Sir, I like to do vote of thanks. I just thank our AVP head, Professional Development Committee head, Sandeep Agarwal sir, to give me to give me this opportunity to thank Natarajan sir. I really want to congratulate sir for passing the International Valuation Certificate Examination by IACBS. And the kind of insight this which sir has given in this webinar is mind blowing. Actually, being a valuer, many of the areas which sir has highlighted has been overlooked by many of us. Like as sir has rightly pointed out, like people used to take basically for illiquidity discount, we used to take certain percentage in our valuation without understanding the basis or factors which should be considering while arriving at the illiquidity discount and the cost of capital which sir has pointed out rightly, like in CAPM, only systematic risk is being covered. The unsystematic risk is not being covered, and how to take care of all that. And the the insight which sir has given about the different, the beta rate, the illiquidity discount, and also the regression which we can do from the company perspective is really really very good. And it gives the valuer and edge to learn more and apply more, and think out of the box, basically, to while doing the valuation, not only look into certain aspects of the company, but also to look something which is beyond that. I'm really thankful to sir for giving us the broader perspective to look at valuation, and the broader aspect to arrive at the cost of capital. And we are looking for more such kind of session from you, sir. As you rightly said, like discount for lack of marketability, there is a need of having more session and deep dive session on the same. So as you have passed from the international valuation, international examination, so we from the AVP would like to take the privilege from you to get this insight and learning more and more. Thank you, sir, for such a wonderful session again.
Thank you, Nidhi. I think
Thank you, sir.
I need to live up to that. Whatever you are mentioning, there's a lot of thing to learn, and learning is a continuous process, and we all should try to adopt that attitude. Thank you.
Yes, sir. Good night, sir.
Thank you, Natarajan, for wonderful session.
Thank you, Bhave sir. Thank you, Sandeep, for providing this opportunity. It was really good. Thank you.
Thank you.
Thank
Good.
you, sir. Thank you.